You're listening to the Shaughnessy Group podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Welcome back to the deep dive. We are really glad you could join us today.
We really appreciate you spending time with us.
Today we have something a bit different. We get to look behind the curtain, at a live operational document. It's a fascinating snapshot of an M&A deal in the making.
That's right. This isn't a case study looking back at something that already happened. Our source for today's deep dive is a document called a Family Office Business Acquisition Mandate, and it's dated January 1, 2025.
So it's like we're at the starting line.
Exactly. It's the starting gun for a major financial move.
And our mission today is pretty straightforward. We want to unpack what this mandate actually means, who the key players are, and, well, most importantly for you listening, understand the strategy that's really driving this whole thing.
And the main player here is a publicly traded company. They're based in Canada. And their goal, on the surface, seems pretty simple. They want to acquire a business that's similar to their own.
It sounds simple, yeah. But the way they're going about it, the mechanics of the deal, that's where you start to see this really complex and very calculated financial strategy at play.
It really is.
So let's just jump right in. Let's start with the basics. This advisory group gets what's called a buy-side mandate. In simple terms, what are they being asked to do? And why would a big company even need an intermediary for this?
Okay, so a mandate is just a formal instruction. And buy-side means their client is purely in the market to acquire something, to buy a company, not to sell.
They're shopping.
They're shopping, exactly. And they hire an intermediary because buying a company it's not like buying a house. It takes this specialized knowledge, specific deal structures, and this is the critical part, a huge network to find the right companies that fit their exact criteria.
So the intermediary is sort of like a scout and a deal maker all in one.
A scout and a facilitator,
Yeah.
Precisely. And in this case, they're working for this Canadian public company to, make their strategic goals a reality.
And the mandate spells out those goals. This is where it gets really interesting for me. It says, the whole thing is driven by an industry consolidation strategy, that phrase. It feels like the key to this entire transaction.
It is. It's absolutely the central pillar of the whole thing. Industry consolidation is a strategy where a company, often a larger public one like this one, starts systematically buying up its competitors.
Or at least similar businesses within the same sector.
Right, over a set period of time. It's a deliberate campaign.
Okay, but why? What's the benefit of going down that specific path? I mean, especially for a public company that has shareholders to answer to.
Well, the benefits are they're layered and they're really powerful. If you think about the big picture, there may be three immediate goals. The first one is just reducing competition.
Simple enough.
If you buy your closest rival, you instantly get their market share, their customers, their supply contracts, everything.
So it's instant growth. You're not fighting for every new sale.
Precisely. And second, and this is so critical for a public company, is achieving what are called economies of scale.
Right. So when you merge two companies, you can get rid of all the duplicate costs, right?
Exactly. You don't need two payroll systems. You don't need two separate legal teams or two headquarters. You streamline everything, and that drives down the cost of every single thing you produce or sell.
And that drop in overhead goes straight to the profit margin. Can you give us an example, something that shows how deep those efficiencies can go beyond just, cutting staff?
Yeah, of course. Let's imagine our Canadian public company is a national supplier of some kind of specialized component, and they find a smaller but really efficient regional supplier.
Okay.
And this smaller company has its own proprietary logistics software and a brand new warehouse in a key area where the big company is currently pretty inefficient.
So they might have an older, clunkier warehouse nearby.
Exactly. So the consolidation, it's not just about shutting down that old warehouse. It's about taking that smaller company's superior software and rolling it out across the entire national operation.
Wow. Okay.
So they get the warehouse and the location, sure, but they also get a massive tech upgrade that saves them millions across the board. That's how deep the efficiency goes. You make the whole system better, not just a little bit bigger.
That's a huge shift. You're not just growing, you're fundamentally improving your infrastructure. That's what makes this consolidation play so powerful. It can create market dominance almost overnight.
And it creates a cost structure that your smaller competitors just can't match. Once you have that scale, you can weather market downturns better, you can lower prices, you can really cement your position.
Okay, so we've established the why, the consolidation. Let's pivot to the how, the money side of things. The mandate says the acquisition will happen via equity investment. Now, most of us, when we hear acquisition, we think debt, a huge bank loan. Why equity here?
This is a really crucial distinction, and it tells you a lot about their long-term plan. When a company uses debt, they're taking on a loan, a liability that has to be paid back with interest, no matter what.
Right.
But when they use equity, they're using ownership or cash they already have as the currency for the deal.
So they're using their own resources. How does that actually work in a transaction?
It generally means one of two things. First, they could just use their cash reserves, money they have saved up. Or second, this is very common for public companies doing this, they can issue new shares of their own stock.
And use the stock to pay the owners of the company they're buying.
Exactly. The sellers of the smaller company essentially trade their ownership for a stake in the much larger public company.
Using their own stock as currency sounds incredibly flexible. But isn't there a risk for their existing shareholders? If you keep printing new stock to buy companies, doesn't that dilute everyone's ownership?
That is the critical trade-off. It's the tightrope walk of any consolidation strategy. Dilution is a very, very real concern. But the company's calculation is that the value they create from the deal, those huge economies of scale, the new market dominance, will be so massive it'll more than make up for the dilution.
So a smaller piece of a much, much bigger pie is worth more.
That's the bet. It's a high-stakes bet that the consolidation will pay off and pay off quickly. It shows they're prioritizing financial flexibility. They want to be ready for the next 10 acquisitions without having to worry about bank rules.
They want to keep their powder dry.
Absolutely.
Right.
Using equity keeps the balance sheet clean and lets them move fast when the next target appears. If they max out their debt on the first deal, the whole strategy could stall.
And that choice perfectly explains why the mandate is so specific about acquiring a similar business. If you're risking dilution, you need those efficiency gains to be immediate and guaranteed.
Precisely. If they used all that stock to buy something completely unrelated, say a software company when they're in manufacturing, the integration would be a nightmare. Those efficiencies wouldn't show up for years, if ever. The stock market would punish them for that.
So the similar business part is the safety net. It ensures the puzzle pieces just click together.
It minimizes the integration risk. It's essential.
Okay, let's shift focus to the people making this happen. The facilitator, the advisory group from the source, they're the engine running this whole search for the Canadian company.
Right, and understanding their role is key to understanding the modern M&A landscape. It's much broader than just this one deal. The source material actually lays out all the services they offer.
They're not just a one-trick pony for buyers. What are the three main things they do?
They basically cover the entire life cycle of a company. First, they help owners sell their businesses. That's called divestiture. Second, they help companies acquire other businesses, which is what we're looking at today. And third, they're critical for securing financing for growth.
So finding venture capital or private equity, that kind of thing.
They're like a central hub for any major business transaction.
And that leads us to maybe the most impressive number in the whole document, their network. It says they have more than 16,000 global contacts across 6,000 financial and strategic buyers. That number is staggering.
It is. And that scale, that is the secret sauce for maximizing value in a deal. We talk a lot about strategy, but M&A is executed through networks, through reach.
So what does that mean in practice? Let's say I'm the owner of that similar business they're targeting.
Okay. So if you're that owner, your biggest fear when you decide to sell is leaving money on the table.
Of course.
If you try to sell your business on your own, locally, you might find a few interested parties, maybe a competitor, a local investor. But if you work with a facilitator who can instantly show your business to 6,000 potential buyers around the world,
The whole game changes.
the entire dynamic shifts.
Yeah.
You've just created intense global competition for your company.
And that competition is what drives the price up. Can you clarify the difference between those two types of buyers they mentioned, financial and strategic?
Sure. Financial buyers are groups like private equity firms or family offices. They buy a business to improve it and then sell it later for a profit. It's purely a return on investment play for them.
Okay.
Strategic buyers are other companies, like our Canadian client. They're buying for operational reasons, to consolidate, to get new technology, to enter a new market.
So for the person selling, having both of those groups at the table competing is the dream scenario.
It's the ideal situation. A strategic buyer might pay more because they can see the immediate synergies and cost savings. But the financial buyers can ensure the base price is high and competitive. You're forcing everyone to put their best offer forward.
That's the leverage. The size of that network isn't just about making sure you sell. It's about making sure you get the absolute highest possible value.
That's it. This brings the whole thing full circle. It doesn't matter if you're the big Canadian public company trying to execute a consolidation strategy, or if you're the entrepreneur who built a business that's now a perfect target.
Right. In both cases, this intermediary's huge global network is the engine that determines the speed, the access, and ultimately the financial outcome for everyone.
Exactly. This short mandate really shows us that high-level M&A isn't just about a good strategy like consolidation. It's about having the global connections to actually execute that strategy and to do it efficiently, quickly, and for the maximum value.
So if you're out there listening, maybe you're the owner of one of these similar businesses thinking about the future. Here's a final thought to chew on. Given the power of a network with 16,000 contacts and 6,000 global buyers, how much does the potential value of your company change the second you stop looking locally and decide to enter that global, sophisticated M&A market?
It changes everything. We're very grateful to the Shaughnessy Group for providing these kinds of insights into the world of business acquisition and growth financing.
And if you are curious and want to explore more resources on these topics, you can visit the resources discussed today at shaughnessy.group.
Thank you for diving deep with us.
We'll catch you on the next deep dive.
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.